Max Life Flexi Wealth Advantage Plan. Will this ULIP definitely help you create long-term wealth with a lot of advantages, or will it bring a risk to your wealth with a lot of disadvantages? Let us evaluate. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decision. Before we get into the analysis part, we will look at the key features of this particular policy. This policy has got a key feature, return of all charges, because one of the major complaint on ULIPs is heavy charges. But this policy has got a new variant which says we will return all the charges which we charge in the beginning at the maturity. Okay, does it help you create overall better return? Let us evaluate. This policy also gives you loyalty additions, and that will help you increase your overall fund value. Auto debit booster is also available. If you are paying premiums through auto debit, there are additional benefits given to you. Life cover is also given to you. You can also choose what kind of life cover to have. Some assured to have smart withdrawal options are available. You can freely switch from one option to other fund option. Premium redirection option is also available. You can redirect your premium without any charges. When you are investing in multiple fund options, in which fund option you will be investing, that instruction you can change it any point of time. Tax benefit, section 80C benefit is available, and waiver of premium cover option is also given to you. Okay. When we are looking at all these features, one important thing which we have to look at is this Max Life Flexi Wealth Advantage Plan is a unit-linked insurance plan. That means money you are investing in this ULIP, a portion of that will be taken towards giving you life cover. Balance, there are some other charges which we will discuss in detail later. After these charges, whatever is left, that will be invested in market-related instruments. It can be stock market securities or it can be money market securities. So this fund takes market risk. This is not a traditional endowment or money back kind of plan. No. This is a unit-linked insurance plan. This policy takes risk. So does this policy give you risk premium return? That also we have to evaluate when we are evaluating this policy. This particular policy has got 5 investment strategies. We can choose which one is comfortable for us. We can pick and choose. One is a self-managed portfolio strategy. Self-managed. You can pick and choose which fund to own, what kind of allocation to give, when to switch from one fund option to other fund option. All those things are an empowered investor you yourself will do. If you know about market dynamics and how the funds perform, how to evaluate, then this may be a good option for you. Systematic transfer planners, you invest your money in one fixed income fund option and give standing instruction to transfer monthly or periodically to another equity fund option, or vice versa. You can invest in an equity fund option and you can give standing instruction to transfer it to a fixed income option. So it depends upon your, this is predominantly to do the dollar cost averaging or rupee cost averaging, you will be able to do it. A life cycle based portfolio strategy, if you are based on your age and the life cycle in which you are in, you can choose to have your asset allocation. If your age, when you advance in the age, your equity exposure should come down. Trigger-based portfolio strategy, dynamic fund allocation strategy are available. So based on your requirement, suitability, you can pick and choose the strategy. Death benefit is also given in this policy. Maturity benefit is also given in this policy. First, let us look at the death benefit of this policy in detail. There are three valuations, three calculations. Out of those three calculations, whichever is the highest, that will be given to the nominee or legal hire in case of unfortunate death of the policyholder. You may ask, what are all those three values? First one is 105% of the premium paid. Next is fund value as on date of the death claim is getting filed. Number three, sum assured. Out of these three values, whichever is highest, that will be given to the nominee in case of unfortunate death of the policyholder. Maturity benefit and survival benefit is also available. Guaranteed loyalty additions, auto debit booster, also given as survival benefits. Now, let us look at this maturity benefit via illustrations. Right? There are two variants in this policy is available. One is wealth variant, and other one is whole life variant. We will evaluate both the variants. Wealth variant, we are taking an example of someone who is at the age of 35, paying premium for 5 years and waiting for 5 years. That is total policy term is 10 years. And the annual premium is 2,50,000. That way we are evaluating. And whole life variant, 5 years is the premium paying term, and policy term is 65 years. That means whole life, right? Till 100 years we have to take into account. Annual premium is 1,50,000. We are taking these two illustration and seeing how much rate of return these two example policies can give us. We have taken this illustration from the official website of Max Life. So, and what is the return they are giving is also given here for auto debit booster and guaranteed loyalty addition put together. How much return you can see here? They have given two options. In a worst case scenario, if the Max Life generates only 4% return, how much it will work out? In a best case scenario, Max Life can generate 8% gross return. Then how much return it can give us? So all those things we will see in detail. In the wealth variant, in the worst case scenario of it generating 4% return, after charges and other expenses, it will work out to 2.75% return for an investor. So this 2.75% net return is definitely less than our savings bank account interest. That we have to keep as an important insight or observation. This wealth variant, in case of a best case scenario return, this policy will generate 8% gross return. It will work to 6.63% as the return. 6.63% as the gross return. Gross return is 8%, but the net return is 6.63%. Even after taking a risk, even in a best case scenario, this is giving you 6.63% return, which is comparable to your FD, right? Whereas if we, instead of investing in this Max Life ULIP, if we invest the same money in the combination of term insurance plus PPF, it will work out to 6.04% internal rate of return, which is very close to the best case scenario return of wealth variant. All right. So, but wealth variant takes huge risk, and even in best case scenario, it gives you 6.6%. But PPF, without taking risk, it gives you 7.1% return. If you adjust the term insurance expense, it works out to 6.04%, which is very close to the wealth variant's best case scenario return. Wealth variant is a market risk linked policy. If we take another market risk taking policy of investment option like mutual fund ELSS plus term insurance combination, generally mutual fund ELSS in the past has delivered 12% average return in the long run. If we take term insurance plus ELSS combination, because we are adjusting for term insurance expenses, it works out to 10.93% as the internal rate of return. If you look at the maturity benefits, there's a huge difference. Whereas, if you are a risk avoiding investor, PPF may be a best option for you if you are a risk-taking investor. Based on this example, mutual fund ELSS can be a very good wealth creator for you. Now let us take the second variant, which is whole life variant. In the whole life variant, in the worst case scenario, it works out to 3.23 percentage return, which is again a much lower return compared to your savings account. Like, it is very comparable. So even after taking risk, it is giving you 3.23% as the net return. In a best case scenario, it gives you 7.17% return. But is this really a risk premium return? You have to check up. It's a question mark. Instead of that, if you take a combination of PPF, fixed deposit, and RBI bonds, in this combination, if you invest, right, it will give you close to the risk premium best case scenario return of whole life variant. All right. So that way, this whole life variant seems to be having a disadvantage compared to term insurance plus PPF, FD, RBI bond combination. If we compare the internal rate of return of whole life variant with mutual fund ELSS, because whole life variant is market risk related policy, so to make it as an apple to apple comparison, we got to compare it with another market risk taking investment option, which can be mutual fund ELSS in this case. Even in a best case scenario at 7.17% return, whole life variant based on the example gives us 14.3 crores as the maturity value, whereas this mutual fund ELSS plus RBI bond and ELSS combination, that means in the accumulation stage in the beginning 20 years, you can take more risk. You are investing 100% in ELSS. After 20 years during your distribution phase, like, you are moving 70% to RBI bonds and 30% to ELSS. And that way, if you look at it, it works out to 5.8 crores. There's a huge difference because mutual fund ELSS seems to be a game changer that gives us much better return than Max Life's whole life variant. If you compare, the whole life variant has got a lot of weakness. It is giving you mediocre return, not a risk premium return. So ELSS RBI bond combination seems to be a much better combination for you. Why? Like, Max Life, even after giving you lower rate of return because of its charges. Premium allocation charges are higher, and it is between 4% to 12%. Definitely, this is on the much higher side. Policy administration charges is also from 0.6% to 4.80%. Again, this is much higher. Premium allocation charge and policy administration charges are not justifiable charges. This is for just entering into this policy, you are charged. Generally, when you put an FD or when you put a mutual fund, there is no entry charges. But this policy gives you entry charges, which is something unheard. Fund management charges is definitely a justifiable charges to analyze and pick and choose the right security in which they have to invest your fund. They are charging between 0.90% to 1.25%. This is a reasonable charge and a justifiable charge. Then mortality charges to give you life cover, they are charging. Again, this is a justifiable charge. Waiver of premium, there is additional charge. Surrender charge maybe a justifiable charge, but discontinuance charge, again, this is something most of the ULIPs are charging nowadays. If you are discontinuing the policy in between, again, they charge you heavily. If you are doing a mutual fund SIP for 5 years and discontinuing the SIP after 2 years, there is no charges levied by any mutual funds. So this discontinuance charges seems to be a not justifiable charge. Switches and premium realization charges are not there. However, partial withdrawal, smart withdrawal charges alteration charges are there. All these charges pulls down the net return of the policy. Though they deliver 8%, 4% gross return, the net return works out to be much lower because of these kind of heavy unjustifiable charges. This policy, one major advantage, which is, I would say, a perceived advantage, not a real advantage. This policy returns all the charges, and the guarantee additions and loyalty additions are there in this policy. For auto debit facility, they are giving additional boosters. There are 5 different strategies and 11 funds are available. You can pick and choose the best combination for you. Free switches and redirection is possible through this fund. Lock-in period is 5 years, so no liquidity for 5 years. Return of charges seems to be an advantage, but it is a huge illusion. They say they are charging you, so let us say 10,000 rupees in the beginning as charges, and they are returning it after 20 years or 40 years on maturity. Right? They are returning it without any interest. What is 10,000 today? And same 10,000 after 20 years. So, like time value of money is getting eroded here. Right. Same 10,000. Like actually, they need only 1,000 rupees as charges, right? But they may be charging you 10,000 rupees. Some portion of that they'll invest. That itself will become 10,000, and they are giving it back to us. So, if you really look at it, 10,000 they are deducting, and they are without interest, they are paying it back is not a justifiable way of doing it. It is, I would say, it is a kind of a sales gimmick, because people object and not invest in ULIP because there are heavy charges, premium allocation charges and other charges. So they are charging, let us say, like they need only 10,000 rupees to be charged as charges, but they charge you 12,000. 10,000 they keep it as expenses. Balance 2,000 they invest. It grows, compounds to 10,000 automatically. Even in FD, it will compound after 20 years to 10,000 rupees. That they are returning it back to you, and they are claiming that whatever we have collected and we are returning it. It is not fair to say that. It is not a fair play. It is basically without transparency, confusing the buyer, saying that I have collected and I am paying it back. No, time value of money is an important concept which we have to understand. 10,000 given by you today and 10,000 received by you exactly after 20 years is not the same. 20 years after, from now, 10,000 may not have the same value as of today. That is the sales gimmick or marketing gimmick this policy is playing on us. So finally, we have analyzed this policy, the internal rate of return, compared it with few other investment options. Also, we have evaluated advantages and disadvantages. Now, do we have to invest in this policy or not? Because this policy takes risks and delivers poor risk premium return. It gives you return which are comparable to FDs, and even risk-free investment options like PPF gives you comparable returns. Mutual fund ELSS gives much higher risk premium return, and the return given by Max Life Flexi Wealth Advantage plan is not suitable to beat inflation. Definitely not a good long-term return. Because of all these reasons, it is not worth to buy Max Life Flexi Wealth Advantage plan. So, what can be a best investment option? It depends upon you. If you are a conservative investor, risk-avoiding investor, then you can choose term insurance plan plus PPF investment combination. If you are a risk-taking investor, then in that case, you can choose term insurance plan plus ELSS mutual fund combination. Both these options can be better than Max Life Flexi Wealth Advantage plan. We have done an in-depth, detailed research analysis on this policy, and that research analysis is shared to you via a blog post. The link to that blog post is given below this video in the description box. You can click the link and read the review now. If you have any questions on this particular policy or any other investment options or questions related to achieving your financial goals, feel free to book a free appointment with our financial planner. The registration link to get the free appointment is given below this video in the description box. Also, we regularly organize insightful investment webinars. Uh, every time we call an investment expert and do that investment webinars, they share like long-term wealth creation strategies and investment strategies. You can register for this webinar for free. Again, the registration link for the webinar is also given below this video in the description box. Hope you like this video. I'll meet you soon in yet another useful video. Thank you. Bye bye.